we can say, look, given where interest rates are likely going, given the inflationary outlook, given the valuations, this is a bubble. And it is a bubble. There's no way that anybody could convince me that this is not a bubble. You would have to convince me, first of all, that 2000 was not a bubble. And then you'd have to convince me that, that the risks facing us are less than that moment to begin with. This is a bubble.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today's guest is the perfect expert to discuss a year as volatile as 2025 has been so far. Jam Karsan is founder, CIO, and managing principal of Kai Volatility Advisors and Kai Wealth. He's widely known as Jam Croissant on X. Heading into 2025, Jem warned us that he predicted it would be a year of heightened volatility, and that certainly proved true in the first half of the year. But what about the road ahead? Are we through the worst of the bumps, twists, and turns that the market will throw at us this year, or is the ride about to get rocky again? Well, let's hear straight from the man himself. Jim, thanks so much for joining us today.
Wonderful being here. Thanks for having me back, Adam.
Oh, it's a pleasure, Jam. And I got to apologize. I made the mistake of asking my followers on X if they had any questions they wanted me to ask you, and boy, did they ever. So I only got about 2,309. We'll get through as many of those as we can. But real quick, given that it's been the better part of the year since we talked, well, I guess we talked back in April, but a lot's happened since then. So just quick at a high level, Jem, what's your current assessment of the economy and the financial markets right now at this stage of the year?
Well, those two things are often not the same.
Exactly.
Right?
Yep.
And so I'll separate them and start first with the economy, with the understanding too that again, the financial markets might be very, very different. Then we'll get there. We front loaded a bunch of demand in the economy by announcing we were going to do tariffs, then putting them on pause for 90 days. So there was a bunch of demand earlier this year after kind of the markets bottomed on Liberation Day. Employment looked quite strong. No effects of inflation that, again, yet at that point, given that the tariffs were paused. And we thought, as the Fed had kind of also alluded to, that coming in July or August, that we would need to start being ready to see maybe the effects of the incoming tariffs and the slowdown and the inflationary pressures at the same time. And sure enough, the last unemployment number here that we had in August was a pretty big surprise. And the PPI number that came right after it, which is leading on the inflation front, was also way hotter than expected. So we've talked about stagflation here and other venues for some time. That's a function of structural kind of populism and protectionism and all the things that come with that. And tariffs are the tip of the spear on that. So not surprisingly, we're starting to see that. My expectations is this is the beginning on that front. Stagflation is a very, very tough thing for particularly the working man, right? On the bottom of the stratification bubble, people are dependent on their jobs, A, but B, they spend 100% of their money on goods, right? Yep. And so inflation is a flat tax and not great for those people. So in a populist environment, that is going to increasingly make people unhappy and is frustrating. So in terms of economy, not great. Stagflation is not a great place.
Sorry to interject here, but just on this, we just went through a massive cost of living spike, coming through COVID, which people are still smarting from. And it sounds like you're saying, hey, folks, the beatings are going to continue until morale improves. Like it's
well, I can't. Since 2020, I apologize. I have been very clear that this surge in inflation, which was, yes, some of that was definitely tied to essentially protectionism that was implemented on everybody, right? We all had to kind of close up. Well, putting tariffs on is akin to that, right? If you think about it, we're closing borders. And particularly with our largest trading partners. And so the more that's the case, the more you can expect supply side issues. And that's structurally inflationary. It's also tough for growth. Why? Because it's inefficient, right? Capitalism, the money flows to the lowest point, just like water does, and the cheapest places make it easier to make money and to drive more capital, et cetera, to and produce goods for cheaper, et cetera. And the reality is that's great for economic growth. The current place we're in is not that way. I would add as well, importantly, during COVID, the response to this was also fiscal stimulus, which is a response to populism. And guess what? Here we are again, going into a more stagflation environment again, and my expectations is going into a midterm year that this is going to force more fiscal spending, right?
Okay.
So broadly economically, not great, right? Pretty poor in terms of those outcomes. Now, the response is and has been to create more liquidity, right? It's the old supply side economic model. We are going to, whether it's through the Treasury and shortening duration or in taking over the Fed and lowering interest rates, which we can get to more here in a bit, a supply side response, which is lowering interest rates, increasing liquidity, driving more money to capital, is not a populist policy. It's the opposite. It's what brought us here to this populist moment, right? And the big, beautiful bill is also not a populist policy. It is, again, tax cuts for corporations and largely, removing funding for the bottom 20, 30 percentile. That all of that will is good for growth in a cyclical perspective and can counterweight the stagflationary pressures of the protectionism that is being put in. But it can counterweight in terms of growth. I would argue, though, that it is not going to circumvent in any meaningful amount of time the inflationary pressures that are coming from that protectionism. So yes, can we create I would say we can shift up a stagflationary environment to, instead of negative growth or flat growth, to maybe 1 or 2%, still not great, right, with these policies. But what that's going to do is take inflation, which is 3% to probably 5%. And so, so from an economic perspective, they are trying to deploy policy like we've done before in the past. The problem with that is you have a very populist environment, increasingly a millennial on down generation that is more controlling the voting and the outcomes of politics, and baby boomers that are passing on. And so that's going to, in my opinion, create an increasingly frustrated group and populace that will only, again, drive more fiscal spending, more inflation. Last of all, if you try and lower interest rates aggressively, create real negative rates, that's great for assets, right? That's great for equities and bonds and everything else, right? Real estate, you name it. But at the end of the day, what that's going to do is going to drive more inflation, right? If you take real rates negative, anybody in an institutional level, even on a retail level, they are going to see a 2.5%, 3% interest rate and 4% inflation. And pretty obvious, you want to borrow as much as possible with as much leverage as possible to buy things pinned down. Guess what? That drives inflation from 4 to 5%. And then you have an even bigger gap. And this creates a spiral, not to mention the pull forward of demand that will drive. So we have a system, right, that has gone to its likely terminus in terms of driving inequality and populism and protectionism that we are now doubling down on in an effort to control the stagflationary pressures of that policy. You can keep the plate spinning with that, but the net result will be inflation, more inflation. And ultimately, the check on all of this, even though we could keep assets afloat through a midterm, maybe even the election, like these things can go on for longer than you expect, but the net result and the ultimate check on all of this is inflation.
And just to underscore, if I'm hearing you correctly here, yes, it's more inflation, but this is an environment that capital is much more cushioned against that, the effect of that inflation, and those who own assets are much more cushioned against it. And so you've been saying populism, but the wealth divide, which kind of got us Trump in office, is only getting worse here based upon the current policies that we're doubling down on.
That's exactly right. And so we've had a move towards that populism in the last 4 or 5 years, I would argue Trump's creation and his mandate from what he is kind of, rusted out cities in middle America has been to respond to that populism. He has done that with the protectionism and tariffs and closing immigration, right, on the border. But he is simultaneously, in a more quiet way, in the ways that people don't necessarily understand, doing supply side economics behind the scenes with the big, beautiful bill, as well as massively lowering interest rates, shortening duration. All of those things are massive and will, in my view, counteract and continue to drive inequality. And the net result is a likely stagflation environment that just runs hotter with more inflation. And that net outcome is not long-term good for assets, but short-term quite good for assets. Right. And we can get kind of into that path as we move forward here for markets.
Okay. So I do want to get your high-level thoughts on the markets in just a second, but let me ask you this, and Jim, I don't know if any of this is influenced, by what you've personally seen going on in places like Turkey, but, if we are continuing to expand the wealth gap, there's only so far you can expand. Oh, and we're continuing to pull in future demand, right? You can only do both of those for so long before things start to break, and not even necessarily economically, but societally, right? So where do you see this going in the longer run?
That's the toughest question. It really is, Adam, because you mentioned Turkey. Like, Erdogan has been in power for 25 years now. And he, just the last 2 years have seen anywhere, depending on what metric you look at, 60 to 100% inflation, right? And yet they've managed to control societal unrest largely. Why? How? Well, because of the constellation of power, right? Like they have created a judiciary which is completely at Erdogan's beck and call.
Right. They have a true strongman regime.
Yeah. Correct. No freedom of the press. Polls are controlled, right? So, if everybody thinks that America can't go there, but there's clearly a move towards authoritarianism, not just under Trump, by the way. It's broadly true and has been true now for multiple presidents, right? But the truth is that our system that we hold near and dear here in the US, which we believe to be truly a relatively free electoral process, and has been and is increasingly falling under pressure. And if there is enough consolidation of power, we could, in theory, get to a point where it doesn't matter how unequal or unfair or unjust the distribution of wealth is. Those in power and the oligarchs that we will eventually, that we are heading towards, will be able to commandeer more and more of the wealth. And so that could go on for some time, is my point. Now, generally speaking, inflation is outside of the Turkey example, can lead to dramatic unrest as a flat tax where the poor are the most hurt by it, and already a populist environment. Highly likely you start to see more unrest. The question is, can that be stemmed? And politically, in terms of elections, can that also be, can we avoid the actual political outcomes with force? I know those are crazy questions and things that people here in the U.S. aren't used to talking about, but trust me, being from Turkey, they happen. And by the way, the playbook is, this is not a political comment, whether it's the taking over the Federal Reserve, like we just have seen, or the, little by little, the press and the fake news, or the judiciary. And, there are steps in that direction. It's hard to, the question is just how far will it go? And I know there's an intent to try and gain more control and more power over those outcomes. So that's the hardest question of all. Is what I can tell you is the populist force that we've seen for the last 4 or 5 years is strong. It is growing. It will continue to grow, not only, by the way, from the non-populist policies that are being deployed here, and the inflation that's likely to cause, but by the way, there are other factors like AI, which are only likely to make that worse. And so you put those all in front. Yes, it's a very dynamic situation that's likely to lead to more populist policies, but at the end of the day, if things get worse, and instead of through placating the people who are the most hurt by this and trying to solve that problem, if instead we do manage that through control, the wealthy can get wealthier and the poor can get poorer, and that can go on for quite some time. And that's actually really good for financial assets, but not great for the economy.
Yeah, if you're wealthy enough to be part of the aristocracy that owns assets and can ride that wave for some period of time, it's good. Maybe right up until, if we get to a French Revolution style, right up until the guillotines get rolled out here. But let me ask you this, and look, I'm no political analyst, and this isn't a political channel, but America is still, very, on a relative basis, one of the most democratic countries out there, maybe still the most democratic, flaws aside. So, let's assume for a moment, there's the King Trump argument where just, consolidates more power, takes over the Fed, runs for a 3rd term, and then it becomes an 8th term and all that stuff, right? So there's that potential dangerous path. Not saying it's going to happen, but people make that argument. That's the fear, right?
Mm-hmm.
On the other side, though, let's say the pendulum swings in one of the next national elections, still very populist, but, democratic socialist, right? So, other side of the same coin, right? That doesn't necessarily prevent the type of outcome that you're worried about, right? I mean, if it's just massive government spending on everything and, confiscatory wealth transfers and stuff, but it's still all with the intent of spending. And if it ends up like every other sort of socialist communist regime we've seen before, that's not necessarily the answer. We don't necessarily get to any better place in the long run, do we?
No. I want to be clear. I want to be very clear. The outcome where, and this is really going to blow some people's minds, but the outcome where we go to a more authoritarian environment, which again, I think is less likely than the alternative, by the way.
Mm-hmm.
I'm just saying it's more likely than people could probably fathom, right?
Yeah.
That authoritarian outcome is one of the best possible long-term stories for stocks and bonds and assets. Okay, I know that's hard for people to believe, but that's the truth. As long as, that comes with a big caveat, that the world still uses the dollar and that we don't lose complete faith in America, right? And I don't see that happening because there aren't many alternatives, at least not for some time. Okay, now eventually that could be the undoing of the whole republic. That's a whole other story, right? But that's probably not 10, 20 years away, right? Given the strength and importance of America in the world and the lack of alternatives, okay?
Yeah.
So one of the best things for assets in the next 20 years, let's say, is probably that outcome. I don't think it's the most likely, okay?
Okay.
I know that's hard for people to keep in their mind at the same time.
Right.
But that's the situation where interest rates go to zero, that the wealthy, we have increasing wealth inequality, that a rising tide keeps the wealthy and liquidity flowing, and we go through an AI kind of fueled, oligarchy.
Yeah.
The other outcome, which is much more likely and probably much worse for assets, arguably much better for the economy and for the average person. This is why I really wanted to drive a divide between your question about the economy and the markets. Is a democracy, which is much more likely, where people are unhappy and the populism is not being met with the needs of the people. And now you get a more populist social democracy type candidate, which then shifts us back to more fiscal spending, more populist policy, right? And a attempt to make the system more less inequality, more fair. The problem with that is that is a very stagflation, a much more stagflationary environment. The more we spend and send money to the poor, the more that inequality narrowing means more spending, which means more goods inflation.
Yeah.
And more goods inflation means higher interest rates. And the higher interest rates we have, that's very poor for assets. So one of the worst things we can see for assets is actually a narrowing of inequality in the developed world. Now, that doesn't mean it's bad policy. I would argue that is a scenario where we're optimizing to median outcomes. I think that would be, if we started optimizing, which is what the populace generally, I think, wants.
Yeah.
We want to optimize not to GDP growth or production or technological development. We want to optimize to median outcomes. And if we start doing that, doing what the people want, the problem with that is that's poor for profit margins, that's poor for revenue growth. At the end of the day, that's really good for median outcomes. And that's bad for assets. Basically, labor, right, or inputs gain a greater share of GDP growth, right? And through that process, you get more inflation and narrow profit margins. And we've seen that through history. We saw that in the 60s and 70s as one of the most recent examples of that. And prior to the Fed being involved during the Great Depression, right, before we are on a fiat and we could control these things, we saw a kind of a depression kind of grow out of that, but without the monetary response. These environments are rebalancing, and they can be very poor for GDP growth, very poor for economic growth, but they can rebalance inequality and then take us on the kind of next leg with a much more balanced, kind of stable society. But again, two very different outcomes. I still think the argument we've been making for 5 years now will continue, in that this is a 10, 15 longer term period of populism and the incentives of populism pushing on a rebalancing, the pendulum having swung so far to a free market process of
to capital,
of big capital. But again, the hardest part of that question, to reiterate what you said, is which one of those outcomes is going to happen? I would still point to the more likely being we're in a free democracy and the will of the people will eventually come through. But increasingly, there is a real probability that we need to be cognizant of, and this is the way this is going so far this year, at least, right? That there could be a continued effort that's really meaningful that leads us down a path of control, yet continued policy, which is supply side economics.
Okay, it's super fascinating, and I would love to keep drilling down in this in the long, to get more clarity on what could happen in the long term. But I don't have you forever, so I got to pull it into, I got to pull our beam back into the more immediate road ahead here. Yeah. I also, like I said, I've got these thousands of questions. Obviously, we're not going to get through very many of them, but I want to squeeze a few of them in at least. So, okay, so we have, regardless of where we might go over the next 10 to 25 years, we've got the world we have right now. We had this very volatile first half of the year, up, down, up big. I remember the last time I talked to you, Jam, you said that you thought that there was, because we were coming out of the doldrums, and you said that you thought the year would continue to be volatile and maybe even we might still make new lows before the end of the year. Are you still expecting that type of volatility from here, given how the script has played out?
Yeah, so let's clean up exactly what we were saying and where we are. I think that's important. So one, expected that decline, called it, almost to the day in February. We thought it'd be about 15%. It went down as much as 22. We also prior said that 15% decline we thought was coming Feb to March would likely end up with a rally back towards the highs or even maybe a minor new high. And then we said, look, come the summer or the fall, we would, based on what we knew or thought at the time, we would likely see a retracement from those levels, right? Because topping is a process that would be a bigger decline that could lead all the way till March or June of next year, which could be a much bigger decline that would go even below those lows. That was our view. Okay. We got kind of, and by the way, been fortunate enough to kind of get the turns quite right for several years now. The rally back has gone further than we thought. There's no question about that. We thought it would probably stop somewhere between 6,000 and 6,350 in the S&P. And here we are at 6,450, 6,500, right? Why and where do we think things are going now? Several things. One, I think we underestimated the amount of liquidity and how quickly the administration would provide that. The shortening of duration on the Treasury side has been dramatic. That's been silent QE, and liquidity has been fairly dramatic. Two, we thought, quite frankly, that the Federal Reserve would not come under the administration's umbrella, or their ability to influence policy would not come through till at least June of next year, if that. Given that, yes, they would take the chairmanship, but how do they get the rest of the governors on board? And in theory, you would, if you give a Nixon analogy, you would need some type of recession to stimulate or to justify just stimulating the way that we're talking about now. Was our thesis. Okay. Largely, that was not correct, right? I think that's pretty clear now. Just this week, I think we got, final kind of reality that not only has Trump now taken over at least 3, if not 4 of the 7 governor roles, which also, by the way, control the regional president's reappointment or replacement. So, again, a full takeover of the Fed is now in process. But importantly, we also have gotten now at Jackson Hole a clear reversal of the Fed's inflationary mandate to control, which, by the way, we called for several years ago, but this is happening quicker than we thought, completely abandoning that 2%. Yeah, way sooner than we thought. We have also said for forever that the market is a weighing machine in the long run, but it is a voting machine in the short term. And if you want to call what I can tell you is what's going to happen with confidence in general in the next 10 years. I can also, call turns based on liquidity, but liquidity changes quickly, and the factors that drive it can change in meaningful ways. And one of the first things I'll always tell people is, cannot be dogmatic, and you have to, be water. This idea that you have to watch liquidity, you have to see how things evolve, probabilities change as you move forward, and a lot of that is based on measuring supply and demand, how that's changed. Quite frankly, the amount of demand in this economy, and not this economy, in this market, which again has been driven by both the Treasury and now the taking over the Federal Reserve, is very hard to fight. We can simultaneously, and this is hard for people to think about, say we are at record valuations, and it really is not a question at this point. We are above most valuation metrics from the 2000 top in the S&P, which is the highest valuations ever. And to be clear, also with that fundamental side, back then interest rates were going down. We were in a budget surplus. The USSR had just broken apart, and the US was the uncontested hegemony. I think, the feeling then, having been there at the center of financial markets, was, wow, this next 50 years is going to be the 50 years of American singular dominance, right?
Future so bright, gotta wear shades.
Yep. Yeah. And I think it's fair to say that there's a lot more risks right now than we thought there were back then. And being at those valuations are insane. I want to be clear. And, in 2020 and 2001, 2002, having been at the center of those markets, I thought, no way in my lifetime would we see that kind of bubble happen again. Like literally, again, that was a 25-year-old gem, right? Naive maybe in some ways. But what's changed, there have been dramatic changes to market structure. One, reverse repo, all of the new facilities that came out of 2008 have provided the tools for government to do almost unlimited, provide almost unlimited liquidity, right? The move to a much more activist Federal Reserve with much bigger tools, and obviously the centralization of power in the executive branch, its ability to pull these levers as much as they are doing. Those things are huge. Never mind the increase of volatility products and the structured product issuance and the vol compression and all of the structural mechanical demand that keeps plates spinning. This is what leads to, right, market number go up in the face of really fundamental, gravity valuations, which don't make sense. So both of those things can be true at the same time. We can say, look, given where interest rates are likely going, given the inflationary outlook, given the valuations, this is a bubble. And it is a bubble. There's no way that anybody could convince me that this is not a bubble. You would have to convince me, first of all, that 2000 was not a bubble. And then you'd have to convince me that, that the risks facing us are less than that moment to begin with. This is a bubble. But you can believe it's a bubble and also believe the liquidity, the voting, you have, again, a weighing machine, a voting machine, that the voting machine is so geared, so weighted to the demand versus supply that this bubble will not end here. And the reality is, we had a bubble in 1998. And then the market went up 50% before, the NASDAQ dropped 92% and 95% of tech companies went bankrupt. And so the question is, how does the bubble end? It always ends, almost always ends, with the fastest move at the end, with the most convex move before the opposite. And so, if you're asking me of probabilities of outcomes, given the dynamic that we're seeing, that's where we are. And really hard for people to say, okay, you're saying down, but that you're saying up. What I'm saying is up and up fast and high probability of fat right tail before left tail, and a megaphone of increasing volatility as we get there. I'm also calling for more, unrest from a political perspective. This, and by the way, not a particularly strong economy in the context of all of this. But that's the reality of where this is heading. And even to be clear, when we were talking about this meaningful decline that would come into March or June next year, we were always very, very bullish of what would happen coming out of that decline. The thought was that we needed a recession and a slowdown for the Fed to then come to the rescue, and then the afterburners to come in. They've just moved forward the afterburners. And so, and said, look, we don't even need a recession, and we'll deal with the effects of this from a populist perspective, likely from other means of control. And so, what does that do? That creates more volatility, brings forward the right tail, and creates a much more dynamic end to this story, as opposed to a more choppy kind of down, then up, then down kind of story. The more you go up now, as opposed to kind of burn off some of that and then go higher, the more ultimately this ends poorly. So I'll stop there, but there's, that's how the picture has changed and why it's changed. And importantly, it's not about up, down, it's about distribution. And so the distribution, that fat right tail has grown dramatically through the removal of our holding to a 2% inflation target, through commandeering the Fed earlier and sooner, and all of the centralized control that we've been talking about that is happening within the administration.
Okay, wow, a lot to unpack in there, but I think the underscore is this is the bubble, and what do bubbles do? They pop. So there's a bubble peak somewhere in our future, and then there's a bubble pop somewhere in our future. And if I heard you correctly, Jim, so correct me if any of this is wrong, there's still going to be a fair amount of volatility, perhaps between now and that bubble peak. Go ahead.
You said a very important word, volatility. I just want to reiterate, in 98, one of the best ways, not one of, probably the best way to manage entering a bubble was owning upside volatility, owning upside calls, hedged, so, vol. It was one of the easiest, most profitable trades for almost 2 years into a year and a half to 2 years into the end of the bubble. Basically, upside volatility is priced incredibly cheaply relative to downside volatility, right? But the second you start taking the lid off inflation and start stimulating in an uneven way, you introduce the possibility of dramatic volatility on the right tail. And where those things are priced is in a much normal historic context, which is not where we are. You can own an upside call, you can be short stock, and you can see that call outperform the stock into a rally, which it usually doesn't do, right, for the broad market.
Mm-hmm.
And then when the market goes down, you can also make money on what is a low volatility expanding with the short stock eventually taking over on the tail. So in 98, 99, by far, one of the most profitable trades was to own 6 month, 1 year, 1.5 year, long dated calls, delta neutral, not being long the market, not trying to be short the market, right? But playing that right tail of the distribution and capturing the idea that that right tail is just too cheap. And I think that is the cheat code for dealing with this last chapter. In a bubble, you really need to start realizing that right tail, the world is getting short into what they know is a bubble. Institutions are at the 13th percentile, by the way, up from 0th percentile just several months ago. And they're short for good reason, because this is a bubble. But from a voting machine perspective, and given the amount of buyers that are like liquidity and stimulus being pushed on the demand side, it is an uneven voting machine, and the number can go up way dramatically at the end of this for those exact reasons. And so the cheat code is not to try and short the bubble. It's not even don't just YOLO calls unhedged. I mean, you can, and that might be very profitable given the scenario I'm talking about. Because again, calls themselves are undervalued. But better yet, on a risk-adjusted term, go delta neutral if you don't want to take the risk. But you'll still make a lot of money on the upside and very well make money on the downside when the bubble finally pops. And so think about it in distribution. We don't have to think about up-down as much as where is the market cheap? What is cheap? What is expensive? And what is cheap is that fat right tail at this point.
Okay, so like any good interviewee, you kind of took this to the punchline I was trying to see if it laid there, which is, your expertise is investing in and trading volatility. It sounds like that is sort of a key area of opportunity here, given where you see the market going from here, right?
At least one of them, right? And again, I think that's obviously a core, expertise of ours, right? I would argue there are other opportunities, right? If we're going to from a macro perspective, if we're going to debase and try and monetize our debt, which is what's happening here with the inflation, right? Mm-hmm. And run this hot, and ultimately what that's going to drive, as I said, is inflation. Well, what are the inflation trades, right? You should be focused on the most convex inflation trades you can. We can get to other reasons outside of, by the way, of why these are going to work, other than just, hey, they perform well in an inflationary environment. But the gold trade, the energy trade, whether it's uranium or other similar trades, even the Bitcoin kind of trade, all of these more inflationary trades, particularly the ones that are in limited supply, are likely to perform also very well. And by the way, distributionally, you don't have to bet on up down as much as those things will, with much less risk on the downside, perform quite well on the upside from here. So there are ways to do this outside of just using the convexity of options and looking at volatility. You want to be also barbell. Like that's another cheat code. If we're going to get something convex, there are certain things certain equities themselves at their core that are more convex in these types of environments.
Sorry,
Institutions are sure. Yep.
keep going, but just for the casual viewer who doesn't necessarily know what you mean when you say convex, can you just describe that real quick?
Yeah. So convex, if you own the S&P, it's just a linear, like a market goes up 1%, S&P goes up 1%, right? But there are certain stocks that in certain environments may go up. If the market goes up 2, it may go up 3%, right? And if the market goes up 4, it may go up 7%. If the market goes up 6, it may go up 12%, right? That increasingly have upside capture. Now, they probably have the same on the downside, to be clear, right? But they are more convex vehicles. And part of that is because of their leverage to economic and market outcomes is great. And so those types of names are a way to get more of this right tail in a way without using options as well. And better to do that than, instead of having 100% stock in the S&P, for example, probably better to have 25% stock, in something, in a pool of assets that are going to be convex on the upside, similar to owning a call or, being hedged, in the sense that those things can get you as much performance on the upside into the part of the tail that we're talking is likely into it. If we go up, this is the likely outcome, but likely then to not lose as much into a decline as well.
Decline. Totally get that. So thank you.
Yeah. So that's a barbell approach, right? And that's taking advantage of convexity to deploy kind of a barbell, which is, safe assets or cash with more convexity and a much more concentrated type of investment. So that's another thing, that people should be thinking about given the distributional aspects of what we're talking about. Understand that right tail is driven by the fact that institutions largely, because it's rational, get shorter into high valuations in a bubble. And eventually that's likely to have them get squeezed. And that convexity means, what kind of stocks are likely to perform into that kind of short squeeze, if you will? The things that have been performing this summer into a short squeeze, right? Go find the things that institutions are short and that don't really have a replacement that are going to likely get squeezed. Go find also the narrative names, right? That are going to make, the other, ingredient for a convex bubble is a story. You have to have a story that captures the imagination of the whole market. We had that in 2000, and guess what? We have it again here. That's part of the whole reason this can go. At some point, people have to at least have a reason they can point to why they would be buying things at these record valuations. And, they need a narrative. They need a narrative to tell them this time is different. Yeah.
And so, sorry, just to make this even maybe a little bit more understandable, there's the old saying that the market can be irrational longer than you can remain solvent, right? And that's kind of said a lot about bubbles, right? Like the bubble can go a lot higher than you can get a lot crazier than you think, right? Yeah. So you want to look at things that where the narrative can overpower logic, like that ride the irrationality, right?
That's definitely, again, we're trying to give you different diversified ways to play this, right? Yeah. And that would be a part of the pool of assets you would want to focus on.
Absolutely. For sure, speculative one, but
absolutely.
If you're in a blow off top, in an asset bubble peak,
by definition, playing the right tail in a bubble is speculative. I want to be clear, right?
So, yes, very true. Yes.
Yeah. So, and again, the key is to do it in ways that are balanced, that don't lose money or lose less into a eventual popping of that bubble. Right.
Basically, have the potential to catch more of the upside, but lose less on the downside,
or maybe even make money, like I said, with the call and the hedge stock.
Yeah,
it's hard for people to understand, but with volatility, you can make money in both ways. Yes. The key is how wide is the distribution, not up down, and that's the important kind of concept here. So there are ways to set this up, right, where you can actually do that. And again, volatility traders made a ton of money in 98, 99, but they also made a ton of money in 2000, 2001, 2002. That was a golden period for volatility. But there are ways to do that with more linear or equities and other instruments as well. And again, I think precious metals, some of these other assets, as well as a barbell approach with some layered in shorts as you get higher, is also a decent way to do that.
Okay, and I'll ask you this again in a couple of minutes. We only have about 10 minutes left, but presumably these are the strategies that you are deploying for your clients at Kai Wealth, correct?
So for regulatory reasons, I can't get into too much about the details of Kai Wealth, but I can tell you that we're much more non-correlated. Okay, so this is our goals at Kai Wealth are to be much higher risk-adjusted returns over the long run, with much less beta and much less kind of long-term interest rate exposure. Is to manage risk, optimize to risk-adjusted returns. And so if that's our goal, right, we are focused on finding ways to take advantage of non-correlation, right, and diversification, and take parts of the distribution, right, which some of these strategies do, to create excess returns, right. It is not a 60-40 portfolio,
right?
And 60-40 could do very well into the bubble, right. But we'll absolutely get destroyed into the decline. Not to mention, if we do get inflation like we think, the 40 in particular can really be a drag all along the way.
Right. Won't provide the protection that you normally would hope it would in a market
Correct.
crash. Yeah. All right. Well, look. So the key question, I think, in many people's minds, Jim, is an unknowable. I'm going to ask it anyways, just to let you answer it in any way that you like. But is the when, the whole when of it, right? And I guess maybe the how much and the when of it, right? So I can maybe encapsulate this by saying, so do you, in this cycle, where are we? Are we in 98? Or do we think we're closer to the end here than?
Yeah, it's different than 90. That's the only recent memory that we can point to, right? Because it's the big bubble, it's the highest valuation we've seen, et cetera. But this time is different in the sense that it has much more inflationary pressures, right? Like we did not have that at that point. Right. It's also different in the sense that we are living in a much more multipolar world with global conflict and protectionism, right? And a lot of things that is not where we were in 2000. So the ingredients for volatility from a much bigger macro perspective are dramatically higher. And again, inflation is a key differentiator. So given that, it's hard to say, oh, we're in 98 or 99. And I would argue, whereas that bubble burst, but it was a fairly short-lived, all things considered, repricing that then came back relatively quickly. I would argue, because this is much more structural, and again, this is an issue of rebalancing inequality, which is again a much bigger structural issue. I'd say the higher probability of this outcome is not some type of crash in nominal terms, right? That then resolves relatively quickly with monetary stimulus, which is what we saw then, right? It's much more likely to be something that ends in a combination. Again, I like to think about these things in real inflation-adjusted terms, right? Back then, we had 2% to 0% inflation throughout that period, even some deflation in between, right? And so we saw a nominal correction, dramatic correction, and then kind of resolution. Here, I think we're much more likely to see something where it's less of a crash from this rally, but maybe from a big rally and then a decline, but then a lot of this along the way gets eaten up by a maybe 5 to 10% inflation. And if you compound a 5 to 10% inflation over 5-10 years, that can do a lot of the real adjustment for you. Think again, 60s and 70s, right? As opposed to getting it as a dramatic short decline. And so I think the shape of this outcome will be quite different. And so because of the shape and the timing of it, it's less just right tail, then quick left tail, and then resolution again, right? I think if you zoom out, and I've been saying this since basically late 2021, I think this market goes net nowhere in real terms till mid 2030s.
Okay, so this is what I was just going to ask you this, and you pretty much answered it. But so you see less chance of a big nominal decline or a crash, right? But much more likely probability of a, so we're not going to have a short nominal crash, but we are going to have a long-term real lost decade.
Yeah, I think this is so important. Very few people know this. If you look at 1929 to 19, basically 1929 to 1949, that 20 years, the outcome is very, very similar in real terms to 1963 to 1983. I mean, but most people think those two things are dramatically different markets. One was a deflationary environment, one was an inflationary environment. The difference is in the 1920s and 30s and 40s, we didn't have a Federal Reserve that had the power that it has because it was tied to gold.
Mm-hmm.
So the introduction of a fiat currency allowed, and that's why they did it, by the way, introduced dramatic powers to essentially shave coins to avoid the knock-on effects of deflation and the perception of the market outcome. We don't think of the 60s and 70s as bad as an outcome as the Great Depression. And you could argue that's smart because it smooths the business cycle and creates, like, again, less knock-on effects. Like there were a lot of effects of the Great Depression in World War II and all the things that you could argue were related to that. So it is a smoothing in nominal terms, but that does not change the real outcome, is my point.
Mm-hmm.
And so my point here is, one thing I can say with conviction is there's nowhere way out of this real outcome, or very few ways out of this real outcome. Okay, in real terms. But the more likely outcome, given the tools at the Federal Reserve's disposal, and given what we're seeing that the administration is doing, they're going to use their powers of fiat to shave coins and try and take what they think is the more manageable path, which is inflation. Okay, that doesn't mean, by the way, financial markets don't have to normalize in real terms. And so my point to you is that if I look forward in the next 15 years, I think we've already moved, again, 4 years or so through this, right? Maybe it's, 10 years, maybe it's 15 years. It'll depend on the path. I see a lost 10 to 15 years. I've already been saying this since late 2021.
Yeah.
Of poor returns. And I want to highlight, by the way, if you take 125 years of American data, 60-40 stocks and bonds, if you take that, this blows people's minds as well. There are 3 to 3.5 20-year periods in real terms. So more than half the data set. In real terms, the market goes nowhere for 2 decades. That blows people's minds, I tell them.
Yeah. So as much as people don't want to hear what you're predicting, you're like, it's kind of common.
It's normal. That's actually what happens, market. In 125 years, we have almost 75 years in concentric periods where the market goes nowhere. 1900 to 1920, nowhere. 60-40 went nowhere in real terms. 1929 to 1949, the market went nowhere in real terms. Again, 1963 to 1983, market went nowhere, 20 years in real terms. That's 60 of the 125 years. And then we have 2000 to 2013, or wherever you want to draw that line, different in the sense that it was quick. But again, another lost decade plus.
Yeah.
And if I understand we're drawing lines certain places, but if you only take those other 50 years of periods, which are very concentrated, that 125 years, the returns during those periods are astronomical. And I'm here to tell you, we've reached the end of one of those periods, and we're likely to digest that for a lot of structural reasons, not just because of valuations. The way we resolve that is has several different paths at which it can go in nominal terms, but is likely, given the powers of the Federal Reserve and the incentives, which everything tends to respond to incentives of the powers at play. So again, the Fed kind of told you, and the central, and the government has told you what their preferred outcome is on top of what the incentives are likely to be. So I would play in that way. So it is a bubble, but that bubble can resolve and digest over time through inflation. And I think that's probably one of the major ingredients. That doesn't mean the bubble and the even higher valuations don't come down in a meaningful way. It's just, I think we need to think about it in those terms.
Okay. Well, look, since we're bumping up at the end of our time here, I'm going to reserve to do this, give this the justice it deserves, and the next time you come on, we'll ask this question up front. But would love to get, I have a good sense, I think, of what it's going to be, but would love to get your investing playbook for the last decade, right?
Yeah. So a decade is a long time. And so
Yes.
that I want to be clear, this does, people hear this and then they come back in 6 months and they say, well, you said this was going to go up for the next decade. We need to think about timelines. So I can talk about a decade, but by the way, the things I may suggest for the next decade may not be the things I suggest for the next 9 months.
Absolutely.
Okay.
And
I think
hopefully, Jim, too, we'll have you on here many times to be able to kind of give audibles all along the way.
Right. And that's not hedging. That's just the reality. And actually,
Yes.
I have, again, one thing I'll tell you, for example, I would not invest in the meme narrative names for the next 10 years. But I do think that that's a very undervalued, likely convex right tail play for the next 9 months to a year.
For right now.
Yeah. For right now. And so I think you need to understand those differences, right? And be very focused on that. But your question was 10 years, right? Mm-hmm. And the best thing I can tell people from a very short perspective, from a short time perspective here is you have $500 trillion of stocks, bonds, real estate, private credit, private equity assets. They ballooned, right, to unimaginable sizes globally. Okay. Meanwhile, 3 years ago, we had about $4 trillion of non-correlated, you can argue non-correlated or not, of non-correlated investment. And again, I'm not really including, so we can get into kind of how I qualify that and I can get into the breakdown, but that $4 trillion 3 years ago has ballooned to 15 trillion on the non-correlated side. But understand this is just the beginning. If you have 500 trillion on one side, what happens when that correlated to equities and bonds and everything else, all of that money now needs to find more non-correlation? What happens when 60-40 needs to find a way to make money in a lost 10 to 15 year period? Mm-hmm. We haven't even fully experienced that yet. We saw a little bit in 22, got people moving in that direction. That's part of what's driven the move from 5 trillion to 15, call it. Yep. Right. But if we're moving through a 15-year period or so, where this is likely to be structural and people are going to lose faith in that 60-40 outcome, what do you think is going to happen to the 15 trillion now and the 500 trillion? There's limited capacity in these things. By the way, what are these products that I'm talking about when I say 15 trillion now? Precious metals. Precious metals is about 22 trillion now, but to be clear, 15 or so, I would say 17 of that is in sovereign vaults that are not touched. Yeah. That's irrelevant. There's no supply there. It's closed to investment. And by the way, that's up from 7 trillion total going to 22. And meanwhile, the part in vaults has not increased that much, candidly. Mm-hmm. It's the part that the broad investment world is buying that's driving convexity there. So that's actually gone from 1 to something like $4 trillion. Okay. Bitcoin and crypto broadly has gone to 3 or 4 trillion from 1 trillion in the last 3 years, right? That's another, you could argue, non-correlated. I'm not saying I know there's a lot of arguments about, is it non-correlated? Is it? It is at this point a store of wealth and a form of non-correlated kind of, the money has to go somewhere. And millennials are the tip of the spear on that populism and wanting, they're the next wave. Guess what? That's millennial called. And then we have the other things that are not actual assets, which are hedge funds and structured products, right? And those, depending on how you look at them, hedge fund assets have gone from 2.5 to 4. And that's only in 2 years, probably closer to 2 to 4 in 3 years. And structured products have gone from 500 billion to 2 trillion in 3 years. So we have this And those are just going to keep growing. The use of options, by the way, and zero DTE and using different parts of the distribution to make bets that are more non-correlated, that's also just going to, that is a explosion that we've talked about here that will continue. Expect so much innovation and growth in that space because it's one of the few ways to be capital efficient into rising interest rates, and be express more non-correlated bets, not to mention hedging the other 500 trillion of assets that need to be offset, the risk needs to be offset for. So if you want a big thesis, there's many more that I kind of outlaid already for the next 10 years. Go look at the non-correlated and go look at the non-correlated stuff that's likely to have, that again, gold, precious metals, Bitcoin, that's still early, I would argue. And look at finding ways to get convexity and volatility, not to mention focus on more non-correlated kind of stacking type strategies. Those will do very well in a context of, again, a 60-40 that does not well, right? Particularly relative to inflation. So I think, again, what we're trying to do at Kai Wealth, right, is really take advantage of a lot of those structures and these more non-correlated things to achieve a much better risk-adjusted return without playing that game. So I think that ultimately is the focus that you should have for the next 10 years. Again, that does not mean that should be your only focus now for the next year, given some of the outcomes we're talking about. This is when the Fed, is afterburners and the Treasury is afterburners, and you have short exposure to institutions, and you're heading into a midterm next year. Les bon temps roulent, as they say, let the good times roll. But again, that will not end well. And picking the exact peak of a bubble is also a bit of a fool's errand. Strongly recommend if you're going to do those things, which again, I think there is a place for that, particularly in the next year. You want to be doing it with, again, a more barbelled, hedged approach and playing a kind of that right tail distribution.
All right, fantastic. So two things. One, very important, you want to use the playbook for the stage of the game that you're in, right?
Correct.
And so, as I said earlier, Jim, really look forward to having you back on again, multiple times in the future here, so that you can kind of call for us audibly where you think we are in the middle of all this. But super useful stuff, and I got to imagine this 15 trillion of non-correlated assets. Yes, it's going to grow organically, but as we enter into this lost decade, there's going to be rotation from that 500 trillion of, hey, look, we got to get into something that's performing better. Wow, this much smaller market is doing great. Let's get in there, and obviously that'll have big price implications. So absolutely. I got to wrap things up, given my constraints and yours here, Jim. But most importantly, hey, thank you. This has been wonderful. For folks that would like to follow you and your work in between now and your next appearance on this channel, where should they go?
So kaiwealth.com or kaivolatility.com. You can hit a button on kaivolatility.com to get on kaivolatility.com/news to get our kind of updates that come out weekly or so. And of course, at jam_croissant on Twitter. You can always follow me there. We try and post any videos or other media that we do to keep people in the loop.
All right. Absolutely fantastic. Jim, thank you so much. Really appreciate this fascinating discussion. Thanks for being so generous in sharing, all the details of how you do this. Really look forward to having you back on again soon.
It's always a pleasure, Adam. Thanks for having me, buddy. Look forward to coming back.
All right. Well, now's the time of the channel. We bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual this week by Mike Preston and John Lodra. Gentlemen, thanks so much for joining us. It's always so great talking to Jam, one, because he's just so freaking smart, but he has a very differentiated view on the markets because of his intense focus and experience on volatility. Jim's he's one of those guys like Mike Green, where I really do kind of feel like I'm just hanging on by my neural fingertips, through the conversation, because he's so smart, and I'm just trying to make sure I get the basics of what he's saying. But I actually felt like this one, it went pretty well. We didn't get into the great depths of volatility and all the Greek letters and stuff that he normally goes through. But what he said was no less important. So basically, he thinks that more or less this market's going to continue going up, obviously with volatility, so it doesn't mean we can't have drawdowns, but is sort of on its got a date with destiny with a blow off top here, which is something, Mike, I've heard you say many times. That's your expectations as well. And then, in the post blow off world, I think that's where, the real rubber meets the road. Do we have how much of a nominal correction do we have? But then importantly, as he just talked there, we might end up having a decade where we kind of go nowhere on a real basis. So, Mike, why don't we start with you? What were some of your key takeaways from there? And I got to imagine you heard a fair amount of things that were validating of your point of view, both from the blow off top to really liking precious metals and where they can go from here. But curious to hear what some of your key takeaways were.
Adam, thank you. A lot of what Jam said rhymes with our beliefs here at New Harbor, a number of them. And I guess I'd like to highlight a few things that I thought were most important because I've got almost 2 pages of notes here and I don't want to rehash absolutely everything that he said. But here are what I think are the high points. He said that economically we're in a not great position. That's really no big surprise. He talked some about stagflation. That's what it's looking like we're in. And that the policies that have driven this not great position that we're in have been really unfair. These policies have driven inequality. But furthermore, he said it doesn't matter how unfair policies are, they can go on a lot longer than you think they can. So that's just not right, but it is what it is. We had 10 years or more than 10 years of 0% interest rates on savings. That cost savers close to $3 trillion. And all of that money was funneled into the banking system to recapitalize the banking system. That wasn't fair, and yet it happened, and it's continued year after year. And now interest rates are back up, so it's a little bit better, or we're starting to forget about that time. But this targeting of asset prices, where the stock market always has to go higher, where housing prices always have to go higher, where collectibles always go higher. Guess who owns all the collectibles and the fancy boats and all of the businesses and resort properties and things like that? The very rich. And that's what this asset price targeting has done. It's driven a very, very wide gap in wealth inequality, and yet it can go on a lot longer than you expect. So, and furthermore, we've talked a lot about the fourth turning that we're in here and how we are approaching, we think, a crisis and a climax over the next few years. It's, in my opinion, going to become very evident that these policies were not only unfair, but they caused a lot of social conflict that had a price that we just shouldn't have been willing to pay. Now, all of that has yet to happen, and I know I'm making some predictions here, but a lot of things are going to happen in the culmination of this fourth turning that are not going to be easy to stomach. Lastly, and one or two more things, and then I'll take a break. Jim talked about the fact that we're above the year 2000 valuations. Let me share a quick chart, if you would allow me to there, Adam. And this is from somebody we mentioned quite a bit. John Hussman just came out with a piece a week or two ago. This is his most popular or famous valuation metric, non-financial market capitalization divided by corporate gross value added. And not only are we above 2000, which is back here, at roughly just below 2.8, right around here, we're way above that and have been for the last few years. In fact, since 2020, COVID, we've been above 2000 peaks. But we're not only above that, we're above the 1929 peaks. And why does Hussman use the non-financial market cap divided by corporate gross value added? Because it has the highest statistical correlation to what actually happens in the next 10 or 15 years. In fact, Hussman's work, if I scroll down just a little bit here, when plotted against future returns, shows that we should expect around a -6% annual return on the S&P yearly over the next 12 years. That's pretty crazy. If you invest in the S&P today and even add back 2% dividends, it means that you'll likely have less money 12 years from now than you have today. And it could happen in a very torturous way. We don't know if we're going to have a 70% collapse or if we're going to have a slow drip downwards. We have no idea. But just wanted to reiterate what Jam said about valuations. They're completely off the charts. So lastly, I think I'll pause there, and he talked more about some things that make sense for the future, but I'll let you and John perhaps cover those.
All right. Well, let's transition over here to John, but Mike, maybe I'll let you comment on this real quick before we hand the baton over. So, Jim talked a lot about this ending in more or less a blow-off top, right? That is still sort of your default assumption here too, correct? And I'm going to put words in your mouth, but I've heard you mention that many times.
Yeah, absolutely. We can't predict the future, but if I could share the chart one more time of the S&P, I guess I'd like to do that. Here as we speak today on August 27th, we just put in a brand new all-time high right here at 64.87 on the S&P. This is the daily chart. And the S&P has been respecting the 21-day moving average, which is this light green line all the way up, including this last pullback a week or so ago. And the whole world is waiting, holding their breath, watching and waiting for NVIDIA's results tonight. NVIDIA is a $4.4 trillion company, and it's just a mammoth. And so we'll see. That could move the market. It could cause this squeeze or move higher parabolically or not. We'll see. But if I move out to a monthly chart, you'll see how just crazy this has been. This S&P, look at the pullback in April. It's the biggest reversal I've seen in 1 month, really going back even more so than COVID. I know that more recent results are a little bit perhaps more exaggerated on this chart because of the nature of the chart, but look at this bounce off the 200-month moving average. It was a huge reversal after Liberation Day, and it's been straight up 1, 2, 3, 4 months. So at this point, I wouldn't be surprised to see an all-in moment here. Jem talked a little bit about institutions starting to get short. I think we're early in that process. Wouldn't be surprised to see a squeeze higher. That's what it's feeling like in my bones, so to speak. You can't prove any of this mathematically. It's just some gut intuition and experience. But this bubble has been so big, this everything bubble we've been living through for 20 something years. After this fake out here, I wouldn't be surprised to see a squeeze up towards 6,700, 7,000 even before this is over. So we're not trading from that perspective. In other words, we're not getting more aggressive as the market's moving higher. We're actually getting a little bit more conservative as the market's moving higher by adding some hedges and things like that. But long story short, yeah, I think that we will likely see some kind of blow off top here, the final fireworks show.
All right, but you're still participating in the uptrend, even though you're becoming perhaps more hedged, which
We are.
obviously sounds prudent. And you answered the question kind of where I was going with this, which was going to be, what's a crazy number this could get up to that wouldn't shock you in retrospect? And you threw out 7,000 as, hey, not saying it's going to get there, but it's in the realm of the possible.
It certainly looks it certainly looks possible. And I think a number of years ago you had a different guest on that predicted that. And at the time I thought that was kind of crazy, David Hunter. But I've got to give him credit because it looks like that's what's happening. When I look at these charts, it looks like 7,000 plus is where this market could likely go. But all of this is fake, right? Then it's not sustainable with these valuations. So I would be very careful. If you're not a professional, if you're not hedged, I would not try to participate here too much, at least.
Okay. And John, maybe in handing the baton to you to build on anything you want to build to what Mike and I've talked about so far, if you can, just sort of comment on the hedging, meaning when things get more and more stretched, that's when hedges become more and more valuable, especially if you're still maintaining exposure to the long side. And right now, hedging insurance is still pretty affordable, right?
Yeah, Adam, I want to talk about, in answering that question, I want to reference, Jem often talks about volatility, and he looks at the markets through the lens of an option strategist. And if I could encapsulate what that means to the average layperson, it means thinking about things in terms of probabilities. We in our seats, and anybody that has done this work for a long time, knows and should have a healthy dose of humility, because as much as we have systematic processes to help us try to gain an edge on markets, we don't know the future, but we can use probabilities and factors that underlie them to position prudently. And that's really what is talked about when we talk about hedging and the cost of insurance through hedging. We're talking about the implied probabilities priced into the market as to the likelihood of certain price moves in the market happening. So when the market is complacent, it is collectively pricing in a low probability of, for example, a large move down. Well, it just so happens that's when the purchasing of that kind of insurance, that kind of downside hedge, is its cheapest because the market is not pricing a high probability into that. Just like an insurance company maybe prices flood insurance more richly in an area that suddenly has seen a 100-year flood 3 years in a row, right? It's the same concept. It's all based upon probabilities. So when Mike talks about blow off tops, absolutely, there's a probability. And in fact, a lot of the data that we follow that speaks to the breadth and the strength of the market has flipped really recently back in a very strongly positive way. 3 weeks ago, we were talking to you, and those indicators were starting to stall and starting to tire. They have done an about face rather abruptly here. And that speaks to this really strong underlying tone of the market that can take valuations absurdly higher, even from our already absurd levels. And so it's important to understand that possibility. But what you do about that are two different things. Most of our clients are folks that have worked really hard to save and build a solid foundation. They're not going to be harmed if they miss out on the last juices of a blow off top, but they absolutely will be harmed if they unwittingly suffer a big downturn, which can happen at any time, right? The probability of that happening is certainly there. So in some ways, knowing or having the awareness of a potential blow off top is helpful, probably first and foremost in the psychological positioning of being okay with missing out in a late stage market rally and not trying to chase every last drop, which usually ends badly because it turns down very quickly. So yeah, we have started to build in some very modest hedging. We haven't done anything too robustly because our system, our indicators have suggested that this momentum is very firmly to the upside. And recent policy news, there is literally a coup going on at the Fed. It's no surprise, no secret that there are wranglings going on in the administration to basically get it a majority at the Fed that will, acquiesce to very strong calls by the current administration to lower interest rates. We think that's very short-sighted. We think it just adds fuel to an already very inflated market that was very much the product of nearly a decade of zero interest rates. And I'd just like to share a chart here to remind folks that lowering short-term rates by the Fed isn't necessarily a good thing, right? Here is a chart that shows what happened to the yield curve between now versus September 18th, when the Fed first started lowering the rates. That was the red line. Okay, so this is the overnight rate here that the Fed controls. At that time, it was 5.25. It's now down at 4.25. They've dropped a full percentage point. But look what's happened as you go out the curve. The long end of the curve has moved considerably higher than the short end in that roughly year since this rate drop campaign has occurred. And just this past Friday, there was a very strong market reaction to what the market read into a very dovish communication from Jay Powell at his Jackson Hole speech. And we had what's called a 90% day. 90% of the issues on the market advanced on the day. That is a very rare occurrence. Only 25 times, I think, since 1980 has that happened. Now, it's a mixed bag in terms of what that means going forward, but more often than not, that means very strong markets ahead, if history is any guide, except when we're in the vicinity of an all-time high, which we are. And that's been a much more mixed bag. One of the instances, for example, was in, I think, September of 2007, a similar 90% day within very small percentage of all-time high. And we know what happened in the year that followed there. So it is a very uncertain market, one that even with the strong, robust indicators we're seeing, we think demands a healthy dose of caution. And the first and foremost and cheapest form of hedging is to simply reduce your risk. We are underweight equities. We have been for some time. We're doing quite well for clients. Certainly our allocation to precious metals has contributed a very healthy dose to performance this year. But it is a tricky market that we're in right now, and it will continue to be so.
All right. So that term uncertain market, very true. I feel that probably a lot of people who've watched this video are probably feeling like, oh my gosh, it just sounds so like confusing what may happen from here because it could be kind of chaotic, right? We could be melting up into some blow off top, but still have volatility along the way, but then potentially another, another drop after that, and then maybe there's going to be some rescue efforts by the central planners. I'll mention in a moment the upcoming Thoughtful Money Fall Conference, but we're titling it, an uncertain year. What do the expert thinks lies ahead for 2026? I think this word uncertain or tricky that you just mentioned, John, really does capture kind of the gestalt of what we all have to deal with here, which is that there are a few things that I think we can have a lot of confidence about, and we have to be prepared for a whole bunch of different potential outcomes in the near term. So, all right, gents, I have to wrap things up from here, just given time-wise. Thanks so much for jumping in again this week, guys, making sense for this for us. We'll next week give you guys a little bit more time to catch up on anything else that we didn't talk about this week, especially with everything going on with the Fed, with interest rate expectations. Very importantly, I think a lot of people are trying to think about, okay, well then, geez, how do I position for this type of future that Jam and you guys think may lie ahead here? Obviously, you guys can help with that. So as I say, every week, unless you've got a really good track record of investing in highly uncertain periods like this as a DIY investor, most of the people watching this video could benefit from the guidance of a good professional financial advisor, but and really importantly, one that takes into account all the macro issues that we've been talking about here today. When you put that requirement on, the universe actually shrinks a great deal. So folks, if you've got a good one though, who meets that criteria, who's creating a strategy for you and executing it for you, fantastic. Don't mess with success. But if you don't have one, you'd like a second opinion from one who meets those criteria, consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses, perhaps even John and Mike and their team there at New Harbor. To set up one of those consultations, just fill out the very short form at thoughtfulmoney.com. Again, these are totally free consultations. There's no commitment to work with these firms. They'll just sit down with you, give them their specific advice for you once they learn about your own personal situation. It's just a free service they offer to help as many people as possible. In wrapping up again, the Thoughtful Money Fall Online Conference is now available for registration. It's still available at the lowest early bird price discount that we're offering. So if you want to lock in that price discount, go to thoughtfulmoney.com/conference right now. The faculty is phenomenal and keeps getting better. Breaking news, Sven Henrik just committed that he'll be back again this year, providing his latest TA. If you want to lock in that lowest early bird price, like I said, go to thoughtfulmoney.com/conference. But if you're a paying subscriber to the Thoughtful Money Premium Substack, make sure you check out the code that'll give you an additional $50 off of that low price. John and Mike, you guys are going to be participating in that throughout the day. Always love having New Harbor be such a key participant in that. Really great, both for me, but also for everybody to ask you guys questions live throughout the entire day as new important concepts get brought up there. That being said, we're going to wrap things up for this week. Again, John and Mike, thanks so much, guys. I really appreciate it. Always great to have you on here.
Thank you, Adam. Great to be here. We'll see you next week. We'll talk more about gold and silver and the miners and everything else that's going on that we didn't get to this week. So thanks.
Thanks, Adam. Always great. And I wish all your viewers a wonderful Labor Day weekend here in the U.S. Hope everyone enjoys some downtime over the weekend.
That's right. All right. Boys, have a happy Labor Day yourselves. Everybody else, same to you. And thanks so much for watching.
At the end of this, it's going to be a silver standard, not necessarily a gold standard. Going back to gold would be better where we are now. But the real end of the inflationary system is when credit is going to collapse. When credit collapses, dollars don't work. And if dollars don't work, none of the other currencies work either, because that's what we say reserve currency, right? That's currency that's in the basement of all these other central banks. So when the dollar falls, or these other currency falls, all credit falls, all credit derivatives, and then you're left with all the purchasing power of all that lost purchasing power gets vacuumed into silver, even more than gold, which is why we're going to go eventually to very near a 15-to-1 ratio, which is the historic exchange ratio, monetary exchange ratio between gold and silver. That's natural economic law.
Analysts note that in a crisis, gold and silver could surge, with the gold-to-silver ratio potentially falling from 90-95 to 1 back toward its historic 15 to 1. Silver's dual monetary and industrial uses, combined with its affordability, may spark strong demand from ordinary people. While fiat collapse isn't directly emphasized, stress from dollar weakness and debt issues could still drive a rush into physical silver. Rafi Farber, also known as the endgame investor, is a financial writer and precious metals analyst. Silver played a central role in global trade for centuries, particularly in China, where taxes were often paid in silver, thereby tying the economy to the metal. This dominance shifted after the U.S. Coinage Act of 1873, known as the Crime of 73, which demonetized silver, hurting miners, farmers, and debtors while favoring the wealthy who held gold. Attempts to restore silver through the Bland-Allison Act, 1878, and Sherman Silver Purchase Act, 1890, were short-lived, and the system remained gold-centric. Recent scholarship also highlights how silver's volatility, particularly in Ming China, fueled both trade growth and inequality, concentrating wealth among elites at the expense of ordinary people. Rafi argues that societies built on financial theft eventually face a reckoning, just as debts must eventually be settled. In the endgame, silver will likely return to a stable 15 to 1 ratio with gold, forming the base for rebuilding a more honest economic system. Gold and silver are regaining importance in global trade as nations transition toward a hybrid system that blends traditional money with digital tools. Despite slower global growth, metals are forecast to rise over 30%, driven by fiscal pressures and safe haven demand. Analysts also suggest silver could outperform gold due to the historically high gold-to-silver ratio. Before we examine the video, please click the bell symbol and subscribe to receive updates on our latest uploads. We always value your thoughts and feedback.
A lot of people say, and I think they're correct, that we've talked about the pyramid, right? And gold is at the bottom. But underneath the gold is an even smaller triangle of silver in terms of value. Look, before gold was money, we talk about gold standard and going back to gold standard, and this is what we have to do. But really, it's not exactly that. It's really going back to silver is what we need to do, or what will be done. I understand that, trading silver coins is not economical in the sense that it's very bulky, and you can't actually exactly do that in today's world. But the human civilization started not on gold, but when we really started global trade and continents started trading in the Silk Road, and Africa started trading with Asia, and you really got a big economic system going, it was based on silver. And what happened in 1873, right, with the crime against silver, or what exactly they call it? I think it was the crime against silver. What happened was, who owned silver back then? It was the poor and the middle class. That's what they used for their money. What did rich people do? How did they store their wealth? They stored it in gold because they had too much silver. They couldn't store it all. Right? And so they had a lot of gold. So what's the best way, if the middle class and the poor, and there's a lot more middle class and poor than there are rich, what's the best way to take purchasing power from the middle class and the poor and give it to the rich? If you're on a silver standard, move to a gold standard, right? That's how you do it. But everything that the government does in order to keep the pyramid going is basically a theft of the middle class and the poor, for the favor of the rich. We have to go through a reckoning. That's natural law. Like, just as all debts are paid either by paying the debt or defaulting, all theft is paid too. Because when you steal that value, when you make an exchange of two people and they're both benefiting, legitimate, when you steal, one loses at the expense of the other. And so you have a net negative effect on society. So when you have a society that operates through these sorts of theft systems, those thefts and those debts are going to be paid one way or another. Now, I have no dollar figure for where silver is going to go in the end game, but I do believe strongly that the end game bell. How do we know when this is all over? Like, the bell's ringing. Okay, well, the dollar has collapsed. It's going to be at a 15 to 1 gold to silver ratio, one that's relatively stable. I'm not saying like we hit it one day, like in 1980 it happened for a day and a half or something. I'm saying this time it's going to stay that way until we can rebuild a basic economic system again. So it could be a year or two, three. I don't know, but I'm saying it's going to be stable enough that silver supplies can filter through the economic system, physical silver supplies, and that figuratively almost literally creates a base of wider silver dispersal where you can rebuild another credit pyramid, hopefully an honest one where all debts are paid and you don't have fractional reserve or however you think the banking system functions. Well, what does the United States look like? I really don't know, which is why, frankly, I don't want to live here. I don't know what Israel's going to look like either. I'd rather be with my people than being here, precisely because I don't know. I would imagine that states could break off from the federal government. The federal government could dissipate, and you could have regions, different regions. Like if the South had won the Civil War, you'd have the Confederate States and the Northern United States. So it might break into a few pieces. I think there's going to be serious trouble in the very big cities like in LA, New York, Chicago, Minneapolis, where you're from. These places that are morally rotting. They're not going to do very well. But I think outside of that, you will have Americans, and America will exist. The United States as it exists now, I don't know. I can't say yes. I can't say no. It might reorganize into some looser government or Articles of Confederation or something. Or California, New York could cede and then leave the more fiscally responsible states into some other union. It could be anything. I just hope that we get through it with the minimal amount of suffering.
Rafi relates that the rise in prices we see today is only an illusion created by the inflationary system. When measured in real money, gold and silver prices have actually been falling for decades. If someone consistently saved part of their income in gold or silver, over time, they would need less of it to maintain or even improve their standard of living. The point isn't to stack metals to cash them out for more dollars later, but to step outside the illusion of the dollar system as much as possible. These metal-focused trends reinforce the notion that the current system creates an illusion of rising prices when measured in dollars. At the same time, real value units, such as silver, offer an accurate preservation of purchasing power. Rafi points out that the de-dollarization movement and individuals turning to gold and silver echo your point about trying to live beyond the constraints of the fiat system. Analysts predicting outsized gains in silver align with the idea that steady savings in metals could result in maintaining or improving one's standard of living over time, even as the dollar erodes. Now, let's recall the interview.
It's not that prices are rising. They only seem to rise within the inflationary system, within this illusory system that we're all stuck in, like a prisoner's dilemma, and we're all stuck in it. Prices are they've been going down since 1960s. I mean, if you look at everything priced in money
And gold.
I mean gold and silver, mostly gold, silver secondarily. But if you look at actual prices, they're going down. And so the prices are only going up if you insist on maintaining your economic existence within the illusion itself. And you could say, okay, fine. So let's say I want to get out of the illusion and just, take all of my salary and just buy gold with it every month. Well, I understand you can't do that because you need to be liquid, and gold is not as liquid as dollars. It would be if we were on a gold standard, but it's not. So then you could say, so then, we are losing out. But it's not just that prices have been staying stable in gold. They've been falling in almost every category. And anything priced in gold is going down. So even if your dollar salary is less, right, then the amount of gold would keep going down with however much you could put away every month. Let's say you earn like $5,000 a month, and you put, $1,000 a month away or $500 a month away in gold and silver over 20 years, and each month it's less and less gold and silver because they keep going up. But you need less and less gold and silver to even have higher standards of living. So you can live outside of this illusion. That's what I'm trying to get people to understand. It's not about stacking and then becoming rich and then using gold and silver to accumulate dollars. We're getting out of the illusion as much as we can. It's like like a drug addict, right? If you're talking to a drug addict, you have to understand how they think You can't go completely into their world, but you care for them, so you need to communicate with them in a way that they think that you're on their planet. But you have to. It's a very difficult position where we are, because we have to put a leg in the illusion, and we have to keep a leg out of it and keep our minds together, which is it's very difficult even for people like us. It's all the more difficult for people who don't understand intuitively with the confidence that gold is actually money, and it still is today. That was the final piece that fell into place for me. That only, I think, like in 2022 or something like that, when I finally understood, when it finally slipped into place that everything is really based on gold and silver in this entire pyramid that we're living on. The higher we get on it, the thinner the air gets, and the more insane we become, keeping one leg in it while trying to keep one leg out. But
Rafi Farber's insights highlight silver's historic and future role as a form of real money, capable of preserving purchasing power and providing stability when fiat systems fail. With de-dollarization underway and precious metals gaining ground in trade and investment, silver's potential resurgence to its natural balance with gold reflects both a historical truth and a practical strategy for navigating today's uncertain financial landscape. If silver does return to a 15-to-1 ratio with gold, what impact would that have on global wealth distribution? How can individuals today best position themselves to step outside the illusion of the fiat system while still meeting everyday liquidity needs? We'd love to hear your thoughts, so feel free to share them in the comments section below. If you enjoyed this content, don't forget to hit the like button and subscribe to stay updated with future posts. Thanks for being part of the journey.
Gold's $3,653 an ounce. That old high at 3,500 is now support. Old high is now probably old resistance, probably now support. I think the next round level is 4,000. Gold ETFs, massive inflows, and there's a lot of room in gold ETFs. Just get back to the old highs. So massive inflows there, but it's a major shift. Key thing to think about gold here is here's a key risk, I think, for gold for then. So I think gold has a lot more room to the upside. Significant correction, it might get near 3,300, but 3,500 is first support. I think the next round number resistance around 4,000. As far as timing, the bottom line for gold to really accelerate will be if the U.S. stock market rolls over the year. I still expect gold to be one of the best performing major assets this year.
Gold is holding around $3,653 an ounce, with $3,500 as key support and $4,000 as the next resistance. ETF inflows are strong, showing a major market shift. While a pullback toward $3,300 is possible, the bigger picture points to more upside. A sharp rally is likely if the U.S. stock market weakens, and gold is still expected to be one of the year's top-performing assets. Bank of America and J.P. Morgan expect gold to surpass $4,000 per ounce by Q2 2026. Supported by strong demand and macroeconomic factors. Mike McGlone is a seasoned senior commodity strategist at Bloomberg Intelligence. He explains that gold is driving the broader precious metals rally, with silver and platinum also benefiting. Gold is up about 40 to 45% this year, pushing ETF inflows to their highest since 2023 after years of outflows, while central bank buying remains strong. The $3,500 level has become key support. Goldman Sachs warns that gold's price could increase dramatically if the Trump administration's attack on the independence of the U.S. Federal Reserve is successful. Ray Dalio has warned that U.S. markets are risking a hard attack due to massive debt burdens. He suggests gold be used as a protective asset, advising 10 to 15% portfolio allocations because gold tends to hold value when other asset classes falter. Risks include geopolitical shocks, U.S. stock market strength, and high interest rates, but gold appears to be anticipating a reversal in equities. A significant stock market downturn could trigger the next big surge, with support around $3,500 and potential corrections toward $3,300. As we start the video, don't forget to hit the bell icon and subscribe so you don't miss any updates. We value your opinions.
They're all basically going up on the back of gold. Good example is silver. Silver and gold are both up about 45% on a one-year basis. Yet silver is known as the devil's metal for a reason. It's leveraged gold. It typically trades 2 times the volatility. On a risk-adjusted basis, it should be up 90%, but that's what's happened. Gold's pulling everything along with it, particularly platinum. In May, I think that gold-platinum ratio reached the highest ever, and platinum just kind of catching up as we're seeing that responsive buying. So everything's bottom line because of gold and because central banks are buying gold, and now ETF buyers are significant buyers of gold. The ETF total inflows have jumped up today as we speak on September 10th to the highest since 2023. It just got above that high from there then, and that's after 4 years outflows. There's a significant inflows into gold, central banks buying, and then everything I think about gold is just nothing but bullish. Obviously, that's kind of the fear when it's nothing but bullish. What stops it? And the way I like to phrase it is every time Mr. Trump speaks, gold smiles. And then, of course, there's those geopolitical things happening with wars escalating. I'm very concerned. So for now, as we speak, it's up 40% in the year about. The last time was up more than that was 1979. CPI was running 10%. Now it's below 3%. So the key thing I want to end with, Ivan, is just how we end this year. Right now, gold signaling there's major cracks in the global financial system, potentially major cracks in rapidly advancing risk assets. And I'm hoping we can get through this year without stock market volatility picking up just a little bit like it usually does.
Yeah.
And I think gold's anticipating that we're going to have some normal volatility pickup in the stock market. It can be very dicey. It's difficult, but I think as far as first put some numbers on it. As we speak, it's gold's $3,653 an ounce. That old high at 3,500 is now support. Old high is now probably old resistance, probably now support. I think the next round level is 4,000. How much higher it goes, I don't know. But yeah, bull markets get stretched, and sure, it's getting stretched. But the key thing is I just checked last week, is you check for what's happening with the underlying market. First of all, what's happening with future speculators. Hedge funds are not way overweight long like they've been in the past, right? They're around 33% of total open interest. They've been as high as 45% of total interest net long. These are managed money net positions. And if you combine with gold ETFs, massive inflows, and there's a lot of room in gold ETFs. Just get back to the old highs. So massive inflows there, but it's a major shift. So I look at it as a pretty enduring bull market. If I were to buy it here, it'll go down 10%. That's just the way my life works. But I think as far as responsive investors, it's a bull market. I don't give investment advice, but I think the key thing to think about gold here is, here's a key risk, I think, for gold for the end of this year. Some significant détente out of Russia, Ukraine, potentially in the Middle East. The U.S. stock market stay on a tear, has to stay on a tear because it's a competition for gold. That's why we've had 4 years of outflow, stock market on a tear. Why buy the rock when stock's on a tear? And high U.S. interest rates. And to me, this is what gold's anticipating is a potential reversion in that very expensive U.S. stock market. The VIX right now, as we speak, is 14.66. The average for the year is 20. And it actually has been going higher. It's just very low right now because we're still somewhat in a summer doldrum period. So I think gold has a lot more room to the upside. I don't think it, on a significant correction, it might get near 3,300, but 3,500 is first support. I think the next round number resistance around 4,000. As far as timing, the bottom line for gold to really accelerate will be if the U.S. stock market rolls over. I should say when, because it's just when. I just hope it's in my lifetime. I think it's going to start this year. And that'll kick in the deflationary forces that you're seeing in China. And potentially maybe in Germany and a lot of the rest of the world's cutting rates because they see what's coming.
Mike McGlone expects gold to remain one of the best performing assets this year, though their call on treasuries has been wrong. Deutsche Bank analysts say margin debt has surged, and the current stock market environment shows parallels with the bubbles of 1999 and 2007. They warn that optimism may persist, but that a sharp correction could be coming. A banking research report emphasized that gold has crushed stocks, bonds, and even Bitcoin this year, suggesting that more investors are turning to gold as traditional risk assets look stretched. Mike McGlone predicts that signs of a recession are building as unemployment edges up, job growth slows, and payrolls are revised down. Global pressures, particularly deflation from China, add to risks. The US stock market is historically expensive, and any reversal could spark volatility. Gold's strength signals cracks in the system, while long bonds may eventually become the next big trade if deflation takes hold. Let's shift our attention towards the interview.
The bottom line is no one wants to see the downturn. I'll start out with how I started the year. I still expect gold to be one of the best performing major assets this year. That's been working, knock on wood, and you got one right. And I fully expect Treasury bonds to be one of the best performing assets this year. I've been completely wrong there. This is from a guy who started in the Treasury bond pit in 1988. I thought I knew that market well. So nothing like markets to humble you. I've been wrong on Treasuries for 2 years. So I think what's going to happen, my fully anticipate, we're at the stage now. I've seen this. It's worse than it was in 99 and 2007 when stock markets go up and makes everybody get involved, and you have to keep, it's a pile-on factor. And I think at some point when it goes down, it's going to go down real fast initially, and then maybe stabilize, because they're so overdue for just hitting some stops, like copper did. Copper dropped 20% in a few hours because it got too expensive for silly reasons, and then just runs through things. So I'm afraid the stock market's going to do that. I don't know what the trigger is going to be, but there's certain times you're supposed to be selling when they're yelling. There's this massive yelling in the market, particularly in cryptos, which I see the most froth. And I just been pointing out that Bitcoin to gold ratio has been flat for 4 years. S&P 500 total return has been flat versus gold. It's been unchanged versus gold for 8 years. The Bloomberg Galaxy Crypto Index has been unchanged versus gold for about 8 years. And gold beats everything. If the rock's beating these assets, there's an indication that you probably should be overweight the rock and underweight highly volatile speculative risk assets that are most expensive by some measures in history. Well, inflation was much higher in 2007 and early 8 when the Fed started cutting rates because of cracks in the financial system. The bottom line is unemployment rate is ticking higher, jobs are ticking lower, and all measures, not just the government data, which is somewhat dicey now because of what Trump did by firing the BLS leader, but ADP data is negative. Employment claims from the states are all tilting downward. So I think that's part of the recession that's kicking in. Now, of course, we've had this significant downward revisions in payrolls, and people have heard this from people like me before that, yeah, I was looking for a recession. My economics team was thinking next recession almost 2 years ago. It didn't happen. It's the delayed reaction that I'm most concerned about, particularly as we have a major discombobulating force, most in my lifetime, of Mr. Trump hitting hard on tariffs in the rest of the world. I mean, this has shifted the post-World War II order. So the rest of the world's seeing that, particularly in China. And you started with yields, and right now as we speak, that 10-year note yield's at 4.06%. The high was around 4.80 on the year. Just a week ago, the high in the 10 and 30 year was 5%. And I think the guide to look to where U.S. yields are going is look over at China, second largest economy. Its 10-year note yield right now is 1.82%. Severe deflationary forces in that country, and they're trying to export that deflation to the rest of the world, partly because they can't export it to U.S. anymore as much. So I think we're heading towards a normal recession. And the bottom line for everything is none of this stuff that I just said to you really matters until the U.S. stock market starts backing up. Because right now we're almost 2.3 times GDP, market cap to GDP, about $70 trillion. And GDP is 30, maybe a little bit above that. That's the most on an end of year basis since 1929 when Herbert Hoover was elected. So I'm afraid that Mr. Trump might just have the disadvantage of poor timing. The stock market's so expensive. We're looking for normal reversions there. And I've seen the indications from gold, certainly gold outperforming most risk assets like Bitcoin and the stock market. And I think the next big trade will be indicative of is what gold's anticipating normal deflation. I said deflation from inflation, which is normal. And that's why I think U.S. long bonds might end up being some of the next big trade. The bottom line for that is U.S. stock market has to go down a little bit, volatility pick up. And I'm prepared to get stopped out on that call by the end of the year if that doesn't happen.
Could a sharp downturn in U.S. equities be the catalyst that drives gold decisively above $4,000? With central banks steadily buying, how much higher can gold's floor realistically rise in the coming years? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us, and wait for the next updates.
I would not be surprised to see silver gap above $40. It never touched $40 in U.S. market hours on Friday. But I would not be surprised to just see silver gap above $40 and just have a big move up on Tuesday. So I would go to Shift Gold now or tomorrow and get some silver. Don't wait for that big move up, because by the time the ETF buyers have a shot, they can be looking at much higher prices. Same thing with gold. I mean, maybe gold will gap up. I'd love to see gold gap above 3,500. That would be something. That's going to be that's a bigger move, because that's about a $50 move for gold to do that. But there's so much that's going on right now, fundamentally, technically, that would support that kind of breakaway gap in these metals.
Gold hit a more than 4-month high on Monday, as increased bets for a U.S. Federal Reserve interest rate cut this month lifted bullion's allure, while silver rose above $40 per ounce for the first time in more than a decade. Peter Schiff expects a strong move higher, possibly as early as Tuesday, and advises buying silver now before prices jump, since ETF buyers might face much higher levels. The same goes for gold. If it gaps above $3,500, that would be a significant $50 move, supported by both strong fundamentals and technical momentum that could trigger a breakout. Peter Schiff, an American stockbroker, financial commentator, and author, highlights that gold appears to be entering its next big rally, likely beginning when it broke above prior highs on Friday, setting the stage for a quick move toward $3,500. As of early Asian trading on Sunday, it was around $3,448 after briefly topping $3,450. Silver also hit a 13-year high Friday, closing just shy of $40, and is now trading near $39.72. Both metals look technically and fundamentally strong, helped by a weaker dollar index, which closed below 98. The U.S. bank holiday is contributing to thinner liquidity, which is also exacerbating some of the moves in gold and silver. Silver is making a move higher in response to expectations of lower U.S. rates, while a tight supply market is helping to maintain an upward bias. Peter Schiff recalls predicting a golden age for gold during Trump's presidency, noting that while Bitcoin is being promoted as digital gold, it has underperformed, trading below its prior peak despite hype, ETFs, and official support. Gold, by contrast, is hitting record highs, far outpacing Bitcoin and stocks. They warn that Bitcoin looks like a pump-and-dump scheme and suggest converting it into gold or silver instead. Let's dive into Schiff's video for more insights. If you find the content engaging, please consider giving us a positive review and subscribing to our channel to receive the latest updates.
Gold, I think, is finally getting ready for the next leg up. In fact, it probably started that leg up on Friday by going through the highs. But now I think we've got clear sailing to get up to 3,500. I think we'll pass that relatively quickly. In fact, I'll take a look at where we're trading right now. Early Sunday evening, so Asian trading has just kind of kicked off. And in the gold market, let me pull that up. Yeah, no, gold's down about 90 cents, 3,448. A few minutes ago, it was trading above 34.50. Silver also on Friday, silver closed at a 13-year high. We came within 10 cents of $40. Right now, we're trading at 39.72, which is up about a dime from where we closed on Friday. But both gold and silver looking very strong. Technically, fundamentally, the dollar was also weak on the week. Dollar index closed back below 98, about 97.80. So weakness in the dollar also working to help the gold market. But I think there are major, fundamental stories that are going to be fueling this gold market rally. I said it on this podcast when Donald Trump gave his first speech as president and announced the golden age in America. I said he's right in a literal sense. It was going to be a golden age for gold. And so far, gold is off to its best start probably of any presidency in history. Trump may not be making America great again, but he's making gold great again, not by intention, but the unintended consequence of his policies, right? He's trying to tout Bitcoin. Bitcoin is only up about 14% on the year, right? Gold is killing it. In fact, Bitcoin is 13% below its peak, right? Clearly, it's not digital gold. Gold's making a new record high. Bitcoin's in a correction. It could easily enter a new bear market pretty soon. And of course, the stock market is, gold stocks are crushing the returns in Bitcoin. But Bitcoin is still today about 13% lower than it was at its peak 4 years ago if you price it in gold. So despite all the hype, all the Bitcoin ETFs, the Bitcoin treasury companies, the strategic Bitcoin reserve, America being the Bitcoin capital of the world with the first Bitcoin president, Bitcoin is still lower than it was before any of that stuff happened. So how is that possible? How can all this good news and all this new buying not drive the price higher? Because there's a lot of people smarter than the people who are buying who have been selling into all the hype. This is a gigantic pump and dump that's going on with Bitcoin. And the big pumpers now are the Trump administration, and all of their friends are the dumpers. But if you're smart, you'll get rid of what Bitcoin you have, and you'll go down to Shift Gold, where we work with BitPay, and you'll take your Bitcoin and you'll buy some gold or you'll buy some silver. This is a holiday weekend, so the U.S. markets are closed on Monday. I would not be surprised to see silver gap above $40. It never touched $40 in U.S. market hours on Friday. But I would not be surprised to just see silver gap above $40 and just have a big move up on Tuesday. So I would go to Shift Gold now or tomorrow and get some silver. Don't wait for that big move up, because by the time the ETF buyers have a shot, they can be looking at much higher prices. Same thing with gold. Maybe gold will gap up. I'd love to see gold gap above 3,500. That would be something. That's going to be that's a bigger move, because that's about a $50 move for gold to do that. But there's so much that's going on right now, fundamentally, technically, that would support that kind of breakaway gap in these metals.
Peter recalls how mainstream financial media often ignored gold, even when it was making major moves. He remembers being on CNBC years ago when gold had risen about $40. To him, that attitude showed a lack of understanding, because gold isn't just a commodity, it's money. Historically, even Alan Greenspan used gold as a key measure of monetary policy, warning that high prices signaled excessive looseness. Today, with gold around $3,450, it's clear that monetary policy has been far too loose for decades. Central banks themselves treat gold as the most important asset, stockpiling it while shunning other commodities. Rising gold prices, Peter Schiff argues, are a warning sign of deep economic problems in America, yet many still dismiss it while hyping Bitcoin instead. He stresses that central banks, the insiders of the fiat system, are effectively dumping dollars in favor of gold, signaling a loss of confidence in paper money. Investors should follow their lead by shifting into gold, silver, and international value stocks, which are already seeing strong returns as money flows out of U.S. assets. Now let's dive into the interview.
They barely talked about gold, as gold was making all-time record highs. I still remember when I went on CNBC back when they still had me on. I hadn't been on like 10 years. I don't know. I can't remember when I was on. But when I used to be on every week, but when I first started going on, I was on Squawk Box, and the host was this guy, Mark Haynes, who passed away quite some time ago now. But the first time I was on, of course, I discussed the price of gold, and I think it was still below 300, or maybe it was in the low 300s. I forget. But I came back, I don't know, a few weeks later, and I'm in the studio again talking to Mark Haynes. And I said, Mark, gold's up about $40 since the last time I was in this studio. And his response to me was, who cares? Who cares about the price of gold? And, he mentioned a number of things where he cares about the price, but he says, I forget, maybe it was bread or oil, I forget. But he said, why should I care about the price of gold? Right? He is the anchor in a financial news show. It's supposed to be focusing on finance, investing, economics. And he says, who cares about the price of gold? I mean, how could you not care about the price of gold? Only if you just don't understand what gold is. I mean, gold is money. It's, you're a show about money. How could you not care about gold? And when the price of gold is going up, especially like this, it is a warning. It is telling you that there's a problem, right? I mean, even Alan Greenspan, I talked about this, he used to use gold as his primary reference to know whether or not he was too loose or too tight. He used to say that if gold gets up near 400, I'm too loose. If it goes below 300, I'm too tight. Now, what does that say? Look where we are now, 34.50. We've been too loose for decades based on Greenspan's metric. But the gold is the most important price. It's not just a precious metal. It's not just a commodity. It's a monetary metal. Central banks are holding gold for a reason, right? How could you say, oh, I don't care about the price of gold? Well, what about all these central banks that are hoarding all this gold? Don't you think that's significant? Because, they're not stockpiling other commodities. They're owning gold for a reason. It is the single most important price out there. And right now it is screaming that there is a huge problem. There is something rotten in the state of America. And that's what you're seeing in the gold market. And, I'm sure that mentality still exists today. The same one that Mark Haynes had, even though he's not around anymore. I think that idea that who cares about the price of gold, right? What's the big deal? It's nothing, right? It's just a rock, right? They care a lot more about Bitcoin than they do about gold. But if you understand what gold is saying, it is a warning. And it's a warning that you had better heed and that you better react to. You better get out of dollars. You better get into gold and silver. That's what the central banks are doing, right? Follow their lead, right? They ought to know. They're like the insiders in the fiat money system, right? So if you see in a company, if all the managers are dumping their shares, they might know something that you don't. Well, this is basically what's happening. The managers of the fiat monetary system are dumping their dollars. They want out. And they're buying gold. They're not buying other currencies. They don't want another fiat currency. They want real money. You should do the same thing. And the same thing is happening with investors. Not necessarily in gold, but they're dumping their U.S. shares and they're buying back their own stock. Right? That's why, my dividend payers fund is almost up 40% on the year now. It's at 39%. It's on the high of the year because value international dividend paying stocks, that's where people are putting their money now. That's where when they sell in their U.S. stocks and they sell their dollars, they're bringing their money home and they're buying value. They're buying income, right? They're buying these dividend paying stocks. I think we're still early in this trend.
Gold and silver are showing clear signs of entering powerful new rallies, with central banks and investors driving demand while the dollar weakens. Peter Schiff emphasizes that gold's record highs are not just a market trend but a warning of deeper economic issues tied to excessive money printing and debt. He argues that unlike Bitcoin, which he views as speculative hype, gold and silver remain true stores of value and the assets central banks themselves trust. For investors, the message is clear: follow the smart money into precious metals before the next breakout accelerates. Do you think gold's rally toward $3,500 will trigger broader recognition of it as the ultimate safe haven? With silver nearing $40, could this be the start of a long-awaited move into triple-digit prices? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.